Do you know that trusts could be taxed up to 40%? And if you set them up incorrectly in your estate planning, virtually half of your estate goes to the IRS? Well, if you didn't, then stay tuned for this FERS Federal Fact Check. Hi, I'm Micah with Plan Your Federal Retirement. Today, we have a really good question that comes in. I know I say everyone is really good. I look at a lot of questions and I really appreciate you guys taking the time and submitting these. But it's also one that kind of pulls on the heartstrings and it's talking about a widow. And so let's hear from Amy. Amy says, I'm a widow and I own an inherited TSP from my husband. Currently, I've listed our living trust as the primary beneficiary for the TSP. From what I gathered recently, the trust is taxed at the highest rate, around 40%. If this is true, would it be better to designate my kids as primary beneficiaries instead of the trust? Does this 40% plus or minus tax rate apply to IRAs, 401ks as well if the trust is the beneficiary? Thank you for your time. Amy, thank you so much for your questions and my condolences for your loss. So as we're talking about this, the basic concept of what you're saying is true, but like most of my answers, it depends, right? There are a lot of things inside of here. You are correct. A trust is taxed at one of the highest tax rates. Not only that, it gets there really, really fast. I don't have the current brackets in my head, so go with me in concept. But for individual filers, whether it's, let's say married filing joint, you're going to get the top marginal income once you make like over $600,000, $700,000 in income. A trust hits the top marginal income around 40% when you hit like $10,000 of income. So not only is it taxed at a higher rate, you hit it really, really quickly. So what's subject to this tax? And this is going to be depends. So I'm going to give you the surface level answer, then I'm going to give you the advanced planning answer. So make sure you're staying tuned for that. The surface level answer is any type of ordinary income generated by the trust is taxed at that. So yes, IRA distributions are taxed at it. Dividends and interest are going to be taxed at it. Potentially capital gains, depending on how it's set up, could be taxed at it. Rental income could be taxed at that rate. So all being taxed at a really high rate. Here's the depends answer. Depends on how your trust is set up. The vast majority of estate planning attorneys, and I'm sorry, I'm going to throw them all under the bus right here. The vast majority of them are only thinking about estate taxes when they create your estate plan. They are not thinking about income taxes, which a revocable trust, which when you pass away then becomes an irrevocable trust. Once that becomes an irrevocable trust, the taxes that trust has to pay are paid at an income tax level. So you got to be looking at both of those things, not only estate taxes, especially depending on what state you live in. Estate taxes could be substantial. Those are death taxes when you die. The government says, great, how much money do you own? Give me half, right? It's a big deal. The second part is an income tax, anything that generates an ordinary income, like an IRA, a TSP distribution. So the challenge is the way most trusts are drafted when I first read them from attorneys that don't really understand income tax planning. They draft a trust that has no pass-through provisions. It's also why I say I'm not an attorney, right? Not legal advice, none of that stuff. You guys know this by now. But they draft without any of these pass-through provisions. And what happens is when you die, the trust cannot hold a tax-deferred asset. It then pulls everything out. And now that entire TSP is taxed at the trust rate, which is 40+%, right? Plus potentially state income taxes, et cetera, going to be there. You have that 40+% going to go to the IRS. If you left it to the kids, this isn't the sole answer. If you left it to the kids, then they could take that money out over 10 years and be taxed at their tax bracket. There's a hybrid option. If the language in the trust, and I can't suggest any language because I'm not an estate planning attorney, if there's language in the trust that allows these pass-through provisions, you can have a living trust. My wife and I have. We have a living trust because we're alive right now. When both my wife and I pass away, our IRAs go inside of this trust and it's passed through to the kids. They still get that 10-year stretch for that 10-year period in time. And it's going to be taxed at their income tax rates, not at the trust rate. So you can have your cake and eat it too, but it must be drafted correctly. And this is where a really good financial planner is going to come in and work with your estate planning attorney and read this and work with them. And I got to say, the vast majority of these documents that I read from someone who doesn't just do estate planning, they do estate planning and everything else, they're using a boilerplate trust that does not meet these rules. So be very, very careful with this. Amy, you want to make sure your assets from you and your husband that you accumulated over time goes to the kids the way you want to, not have to IRS. So this is really important as we go through this. If you have questions about your federal benefits as we're working through these things, make sure you jump on our website, planyourfederalretirement.com, to get more information to make sure you're going on the right path. Till next time, happy planning.